Good morning, everyone. How are you doing today? Good? Oh, great? Oh, wonderful. Wonderful, right? Yeah, so ever since I have known that I have to speak in the morning session, I have been kept thinking that what should I speak in front of you, because you are like very committed person that you want to do the investing, right? So then I decided I want to like pack all my 10 years of experience in value investing and present to you in like 15 to 30 minutes the simple strategy that I use and you can use to beat the stock market as well. Who wants to beat the stock market? Everyone here, right? So the first thing you need to know if you want to beat the stock market, to outperform the market, is to stop being overactive. What do you mean by like stop being active? It means you don't have to like trade a lot or buy and sell a lot, because there are a lot of study and research shows that the more you trade, the less money you can get, right? You can search on that. And this is the latest proof out of the Berkshire Hathaway annual meeting last week. If you haven't heard of it, it's the bet between Warren Buffett, the greatest investor of all time, right? And the Pro-Teach Partner Hedge Fund. What they betting? Warren Buffett bet that if you like invest passively, just buy the index fund like S&P index fund, right? For 10 years, and then you would get better return than you give your money to the hedge fund, like the average return of the 5 hedge fund that the Pro-Teach partner selected. And the bet began in 2008, and after 8 years passed, you see the return of the index fund, S&P index fund, is like 65.7%, while the hedge fund have the average return of only 21.9%, right? So the passive beat by like almost 40%, and the index fund beat the hedge fund like 6 out of 8 years. So that means the more trade you have, or the more you think you can timing the market, you can buy and sell and short and everything, actually produce less return than you like just sitting and buying the index, right? So stop being overactive. I didn't say that you don't have to buy and sell the stock, right? Just stop like over buy and sell like every day, every morning, or like every week. Like stop doing that. And after you like being patient, right? So what should we do next to beat the stock market, to beat the S&P 500 index? Warren Buffett said, if you want to beat the index, if you are the skillful investors, or if you have the ability to select the stock market, you should be a focused investor, right? If you think about it, the market return is the average return of every stock in the market, right? Or S&P 500 is the average return of the 500 stocks in the S&P, right? So imagine if you find the high return out of the 500 stocks, you will always beat the market, right? Because in the market they will always have the higher return or lower return than the average. So being focused and use the right strategy to pick that stock and buy it and hold it for many years, right? Which is the strategy that Warren Buffett always speak and teach us everywhere he went to, right? Buy a wonderful company at a fair price. Anyone heard of this? Right? And anyone try to do this? No? Who can do this? Right? Buy a wonderful company at a fair price. Who can do this, right? Okay. Sometimes like when I was first like investing, I don't even know what the wonderful company is, so I don't know where to start, right? So, and today I'm gonna show you how you can find this wonderful company within a second, right, at the end of the presentation. And if we have time, I'm gonna show you the step-by-step that I use, very easy, that you can select the greatest company to invest. So, if you can pick the great companies to invest, they always outperform the market. If you can see on the slide here, there's like 4 companies here. And fortunately for me, I have the chance to invest in 3 out of 4 of these companies. right? So this is the S&P 500 index. So you have the return of 65.7%. But if you invest in the Ross, so is the off-price retailing store in US, as you can see here, the cumulative return is like 841%. So it beat S&P by like 8 times, right? And out of 8 years here, they outperform the S&P about like how many years? 7 years. So if you just buy Ross in any of these years, even in 2008, you miss it, you can still invest in 2009 or 2011 because the wonderful company or the great company always outperform the market in the long run, right? If you look at another stock like TSCO is the farming supplies company in the US. They sells a lot of farming, a lot of like equipment for the farmer in US. And they also outperform the market by 7 years out of 8 years, and they have the return about 950 something. And so on in the ULTA Ultra is a beauty salon in US, like beauty salon chain in US, outperformed by like 1,000, and the Priceline PCLN, the online travel agency, right? They own Agoda, Booking.com, and Priceline. They outperform the market by 1,110%. So if you think about this, what we should do is to find what they have in common, right? These 4 companies, and then we can find the next one that could be outperform the market as well. So there's a lot of financial numbers and financial ratios that you have to look into it. But since this is the simple strategy that you can use, so I conclude that if you want to find a stock that have like greatly outperformed the market as these 4, you need to look into these 4 numbers. The first one is the revenue. You should look for the company that have the revenue increasing every year or have the spike of revenue increasing like suddenly they increase in revenue like 30%. Before that, they increase like 10% per year. Because when you have the spike in revenue, you see that this company may have launched the better product or service than their competitors. So they have many years to gain more profit. You see something happen quite often in the pharmaceutical industry, right? They launch the new medicine and they gain a lot of money for the next maybe 10 to 20 years when they got patent, right? And the second thing you need to look for is to look at the net income or the profit the company can make out of the sale they make, right? Because it doesn't matter how many sales you make if you don't keep any profit to your company, right? And the third thing is the CFO. It's not Chief Financial Officer. It's the cash flow from operating activities, right? When you look at the CFO, you need to look at 2 things. The first one, and the very important one, is the cash flow should be higher than the net profit in each and every year. Why? Because the net income that you see in the financial statement, it's just the number. It's just the accounting number, right? You sales and you book the sales and the revenue and the profit, right? But sometimes you don't get that money, right? Because it's only like account receivable. So you have to look at out of the $1 in the net income, there's always more than $1 in the cash flow. So you like can certainly sure that the company get all the cash pouring in each and every year, right? And the second thing you have to check out that you should get more cash every year as well, right? So the cash flow from operating should be increasing every year. That means you can expand the market and get more money, and then use that money to expand more business and get more money, right? And the last thing you have to look is the operating margin. There's a lot of margin is for like gross profit margin, operating margin, and the net profit margin, right? There's a different things to look for in each margin. But if you can pick one, just choose the operating margin, because it's really tell you how much money you can make out of the business out of the sale you make, right? Because gross profit is just like the money you make from selling the product net of the cost of goods sold, right? It's not including the fixed cost that you operate the business. And the net profit margin is not the really actual or the accurate margin to tell you that the company is good, because you have to pay the tax or interest. Sometimes you have less tax, sometimes you have more tax, sometimes you have to pay more interest, right? So operating margin is the best indicator for you to choose. And as you can see, the operating margin should be increasing every year. That means the more you expand the business, the more money you can squeeze from your customers, right? For if I say squeeze is like the bad thing, right? No, it's not the bad thing. The more you expand the business, the more money people would love to pay you, and the more cost you can save for operating your business. Better? Yeah. So if you look at the price line, we know that it increased like 10 times since the 2008, right? And what do they have in here? The first thing is the revenue is increasing like from around $2 billion to $10 billion, so it's like 5 times increasing. And the net income is increasing from $182 million to 2.5, so how much they increase? Like 10, 12 times, right, approximately. And the cash flow still increased like 10 times from 300 to 3 billion. And the operating margin increased from 15.4% to 35.3%, is almost 2 times. So if you think about it, that everybody here, I think you know that the stock price always moving in the same line as the profit that the company make, right? The more profit they make, the stock price will be up. So for price line, the revenue increased like 5 times, right? And the operating margin increased, how many? 2 times, right? Then the net profit or the net income increased around 10 or 11 times, right? That's why it drives the stock price to increase like more than 10 times. So if you can find the next company that have increasing in revenue and increasing in the operating margin, is the like double bonus for you, right? Because they can sell more and they can make more money after that. The next one is ULTA Ultra. You can see the similar pattern as the price line, right? Revenue increased like 4 times. Net income increased from 25 to 320, so it allowed around 12 times. CFO increasing, and always, as I said, always more than the net income. You have more cash coming in, right? And the operating margin increased from 4.3% to 12.9%. So this company is even staggering, right? Even though the revenue is not increasing as high as the price line, but it's like the chain store, right? The more you expand, you can save more cost after that. You have economy of scale. So the operating margin increased around 3 times, 4 times. So that combined with the growth of revenue 4 times, you have around 12 times increase in the profit. And hence, the stock price increased from around like $20 to $180. And then TSCO, this is more like conservative and more established the company than the Priceline and the ULTA, right? TSCO have the revenue increasing only 2 times, right? From 3 to 6 billion. The net income increased 4 times, and the operating margin increased from 6 to 10 is around 2 times, right? But that's enough to make the return of the TSCO around 900% since 2008, right? Around 6 to 7 times. And the Rosto is the same pattern, go on and go on, right? Revenue increasing, so repeat yourself after me. So the first thing you need to do is to find a revenue that increasing, like, actually, you may ask yourself, how much growth should the revenue has, right? So the simple answer is what? The more the better, right? But you should look for the company that has revenue growth more than 10% per year, which means they can sell more and make more money than the inflation. Mhm. And then what's the second thing? The net income always increasing. The third thing, we have cash flow coming in, right? The fourth thing is that we squeeze more. We have more money coming into we can save money, save cost, and we have power over the suppliers and buyers. We can increase price. We can lowering the cost of goods sold. We can expand and reduce the fixed costs we pay to the employee, to the landlord, and everything. So Ross store also increased like nearly 10 times since 2008. Now, on the other side, I want to show you the worst performing stock than the market, the underperformed one as well. So you see exactly that they are totally the opposite side of what the good things are, right? For the CEL sale, is the number one market share mobile cellular in Israel. And as you can see, the price dropped from around $30 to around $6-7 in the 8 years, 9 years period, right? So the revenue, what's the revenue look like? The revenue decreasing from $1.7 billion down to only $1 billion right now. So opposite direction. Or the stock price always go to the opposite direction as well, is go to the south. And the net income is even worse than the revenue decreasing. The net income decreased from $260 million to $24 million, 10 times decreasing. So you wouldn't want to own some of this stock, right? You want to own this stock? No, right? If you know in the first hand. The CFO, the cash flow decreasing from 400 to 200. And the operating margin decreasing from 26% to only 7.4%. So you would go to check out your portfolio right now that if one of your stock or any of your stock have the numbers like this, you should consider selling it out of your portfolio, right? Because for the bad or the worst performing company, it doesn't matter how long you keep, how long you hold it in your portfolio. The stock price will be going down. You cannot pray and the price going up, right? Just being realistic. Look at the numbers, the performance of the business. Another stock I want to show you is the JCP, the JCPenney, the chain store, the department store in US, right? And after 2008, it lose the ability to capture the money from the customers. People tend to go to Ross store to buy something like lower price than the regular store, right? And the rich people who have more money, they go to the luxury store, right? So the one at the middle, like JCPenney, they're dying. So the revenue is not increasing a lot, but still increasing almost every year from 18 billion to 12.6 billion. The net income is decreasing from $572 million to the net loss of $513 million, right? Now you're losing money of the company. And the CFO, the cash flow, decreasing from 1.1 billion to $440 billion. And lastly, the operating margin decreasing from 6.1% to minus 0.8%. So you see all the pattern, right? So now, if you understand these 4 numbers and how important it is, what you should look for your next investment, the big question still remain here. Go back here. When we should buy, right? And if I already got this stock, when I should sell, right? So do you have this question? Most people have this question. So I want to tell you a little secret that I've been always looking at all the numbers. The best time that you should always invest in this stock is if you can look at only the single number. What you should look for in this number. Just look at it. I give you like 10 seconds. the best time for you to invest in this company is when you see the spike or the increasing of the operating margin. Because if you think about it, operating margin is the indicator that shows you this company have the edge over the competitors, right? They can have more money and they can lowering the cost at the same time. And if the operating margin they're increasing and the operating margin is much more than their second competitors, you have got something, you have got the edge. And if you think about it again, if you sell the same goods, sell the same product or service like $100 revenue for this company and the competitor, and your company can get more profit from the same sales you make, right? So you can use that money to expand more business faster than your competitor and even can reduce the cost of the operating after that, after expand the business. So that means when you see the spike in the operating margin like this year from 2008 to 2009, 15% to 20%, you know that now this company have something. And this trend will continue again and again for the next like 3 to 5 years. When the company have some edge over their competitors, they still have more times to squeeze, to increase, why I love the squeeze so much, to increase and steal the market share from their competitor and expand more business. And you can see the price line here. In 2008, 15%, 2009, 20%, 2010, 25%. So you have like almost 3 years that, okay, you can invest in this stock. And in 2011, also increased like to 32.1%. And you can see after 2011, that the operating margin is not as have the high growth as before, right? It means the company is going into the saturating point that their edge over the competitor is no longer the huge edge, right? So they have the operating margin increase from 32 to 34 and 35, 36, 35%. That means the company is stable right now. So the growth of the company would come only from the revenue growth that they can expand to more market, not lowering the cost, right? So the first thing if you can look at is the operating margin, right? And the second thing you should look at is the increasing in revenue as well. So as I said, you have like double bonus if the revenue is increasing and the operating margin is increasing. And also again, like in the ULTA Ultra, you can see that the operating margin is increasing here from 4.3% to 5.6 and to 8.2. So this is the time you should buy the stock when you see like the huge spikes, like from 5.6 to 8.2 is the huge one. So as you can see in 2010, after 2010, the stock price like increased a lot after the company has the edge, right? And now you would say, and you have the question in yourself like, okay, and how much is the growth of the operating margin should we look at, right? What do you mean by like have the edge? So the spike should be more than 10 basis point. It means if the operating margin in the 2008 is 4.3%, the increasing should be at least how much? 0.4%, right? 10% of the 4.6%. Because I research and for all the great companies, I do a lot of research. The average increasing in the operating margin should be at least 10% to conclude that they have something right now, and they can keep continue the trend going forward for the next like 3 to 5 years. So here 4.3% to 5.6 over 10%, so it's a good time to buy. And the best time to buy is like once they get from 5.6 to 8.2 is increasing by around like 50%, right? And then so on and so on. Also TSCO is the same thing. You can see The best time to buy is after 2010, right? From 6.0% to 7.3%. And this is where the price should be like just flat, right? The operating margin is not that increasing a lot. And the Rosto, you can see the same thing happened in between 2008 and 2009. The operating margin increasing from 7.6 to 10%. So if you are more hardworking value investor, you're not looking only the operating margin at the end of the year, right? So you look at the margin, operating margin increasing in every quarter. Like in 2009, you don't have to wait until you see the operating margin after the fiscal year ended in 2009, right? You look at the first quarter of 2009 and you see that, okay, operating margin in the first quarter of the 2009 compared to the first quarter of 2008 is increasing around like more than 10%. So you know that you should focus on this company. And then when the second quarter came and you still see that they can increase more revenue and also the operating margin, so you have like very sure thing and you can like invest in that company. And then you know when to buy, right? Now, when you should sell the stock, there's only two things, right? The first thing is you see the decreasing in the revenue. That means the company cannot outsell the competitor anymore. They're losing the market share, or the market share is saturated and they cannot increase the price to get more money from the sales, right? And the second thing, you see that the operating margin is decreasing. That means the company lose their competitive advantage or the moat over the peers in the industry, right? So if you look at the sale, the revenue, they is still increasing in 2008, 2009, 2010, and in 2011, you can see the sharp drop in the price, right? So as I said, you should look at in the quarterly data, not wait for the fiscal data. If you happen to be here at the 2011, you can see at the first or second quarter that the company already lose their competitive advantage. The revenue is dropping, the operating margin is dropping from 29.1% to 21.9%. So if you are a hardworking value investor again, which you should go to look at what happened to the company that reduced the operating margin from 29 to 21.9%. There will be something at the company going on, right? And if you can find the reason why the company lose their competitive advantage, what you should do? You should sell it anyway, right? Because you know nothing. If you know something, you should sell it anyway because that's the reason why the company will keep losing the market share, right? And so on and so on. You can see you should like sell it every year when the operating margin is decreasing. And if you take a look at deeper in the operating margin here, you may think that, okay, here, the operating margin is increasing too, right? So should we buy this stock in 2008, 9, or 2010? As I said, look at for the growth at least 10%, right? If you look at like 26 to 20%, it's only like 1% increasing, which means like around 5% basis point 5 basis point increasing in the operating margin, so it's less than 10% growth. So you should pass this stock. Do not like pay attention to it, right? But if you already have it in your portfolio, you should sell it in 2011, right? And also the JC Penney, when you should sell the stock in 2009 surely, or 2011 when they drop from 4.7% to 0%. So you know this company gonna go bankrupt soon, right? So is that easy strategy? It's easy, right? And you can go back and do your own research and look at these 4 stocks. It's gonna save you a huge amount of time. That I think for me personally, I think value investing is like going to the gym. You have to work hard first to know everything. And after you know everything, It's really easy because you know what to look for. You don't have to do the fancy. One of my idol value investor in Thailand, he said, investment is not gymnastic. You don't have the highest score to play like difficult play, right? Just keep it easy, and if you see something like very match your easy criteria that you can sure like more than 80-90% that you can make money from this investment, just invest. If you have like 50% chance to gain the profit from the investment, you just pass it on, right? Just find something easy to invest and wait for it to grow. Actually, this simple strategy is very easy, but what's the hardest part is the painful things you have to do. You have to look through all of the financial statements of every company in order to find less than 100 companies that have something similar to what I say, right? This is what I first did when I first investing in around maybe 2006 or 2011. I believe in Warren Buffett. He said that if you want to be a good value investor, the first thing you have to do is to start reading the financial statement from A to C, which means you have to read all the financial statements and then analyze it and then pick only the wonderful company that you can invest. And during this process, that's when I found out these like 4 companies and I invest in 3 of them, right? So if I didn't do it, I haven't heard of any of this company, right? So at that time, I used the value line. Anyone use it? Yeah, it's the tool that Warren Buffett used also. It shows you the 10 to 20 years financial numbers and ratio back of every company in the United States. At that time, I think I read around 3,000 financial statements and stock. I spent like 2 or 3 months at home without going anywhere. Even my neighborhood asked my mom, when your son gonna have a job? Yeah, they think that I'm losing my job and just staying home with my mom. But actually, I'm run several businesses already, and that when I want to learn, okay, how can I invest my money rather than putting the money into the bank account? Because at that time, I running like 4 to 5 business and I like burn out. I spent a lot of time meeting and reading people and talk to everyone. And at one day, I think, why I'm working so hard and my money working so little, right? All the money goes to the bank account and get like around 1% interest. And I think, oh, if I want to be rich, I'm gonna die before I'm rich, right? So I switched my thinking and okay, I should stop meeting and I should study investing. That's when I read a lot of Warren Buffett book and do whatever he said in his book, like, okay, start from A to C, use value line, you should buy a wonderful company at a fair price and everything. And I follow his principle. So at that time, I use value line and find out and sort out all the great company. And then I use Google Finance to see deeper in the financial statements. Because as you know, that 4 metrics, that 4 numbers that I show you is only the conclusion, right? But if you are a serious investor, you should look more than that. But that's the first indicator that if the stock that you pick doesn't pass those 4 criteria, you don't have to look at something else because it's not gonna producing you a lot of money, right? Look for this 4 first, and then you look at the debt ratio and the cash cycle and the competitive advantage, the product, the service, and everything. Most people, they go to what first? Most people get tired of value investing because they go to read the annual report first. I did that too. And I always fall asleep when I read annual report. So I think, no more. Why do I have to read like 1,000 words and know that I shouldn't invest in this company? Right? So I switched back to, okay, number first. Because if you want to pick only the great company, number tells you many things. So look at the number first because it's so easy. And if it passes the number, then I go look and check for the annual report to see the risk and to see the product that they sell, the service that they sell, the customers they have, and everything, right? Other than that, just get away from annual report for me. And yeah, so it's really painful for me. And also, not only you have to read all the financial report, all the financial statements, you have to repeat the process every quarter. Because as I said, if you want to make a lot of money, you don't waiting until the end of the year is not fast enough. You have to look at every quarter whether you have the new company, new interesting company you should invest in, whether this company can increase in the operating margin and everything, right? So that's why I think to myself, since I own several of the web technology companies, so I think if I can repeat the process that I do to find the great company, to find a great investment, that would be great, right? So I created the website that you can use as well to tell you the company you should invest at what price. It's called cheetah.com. You can check it out, go to www.cheetah.com. At cheetah.com, you can search for many stocks, and it tells you the most important two things you should consider investing. The first thing is the Cheetah score is on the right hand side here. It represents the quality of the business. It looks to a lot of financial number over the past 10 years. For example, the Roscoe here, they have Cheetah score of 8.1 out of 10, which means this company is a great company, right? As we see, all the number is increasing. And the second thing is when I should buy this stock. I also created the Cheetah line. You can see it's the dot line in the slide. It's the fair price of the stock, and it calculated from all the cash flow and the asset that company make. It's like if you own or if you acquire this company, you can break even within 10 years. That's the fair price of the company. So as you can see, if you combine the strategy in the previous slide, you should look for the revenue increasing and the operating margin increasing. And the third thing, you should buy it under the fair price. If you combine these three things, your money will compound faster than the market for sure, right? And the Roscoe you can see here, the many years since 2008, the price is always under the fair price. So, and the revenue is increasing, operating margin increasing, so you can buy it many years here. And now, okay, the quality of the business, the Cheetah, since I have 10 minutes left, so I will go quickly. So we calculated for many factors, but there's 5 main factors that you can go to look for is a strong brand and the economy of scale, and the company has the cash income, strong financial status, and great management team. The first 3 is what I taught you in the previous slide. If you have the strong brand, you can increase the revenue every year, right? You can increase the price and still sell like crazy. The second thing, economy of scale, is what? Operating margin, right? You can squeeze the money. And the third thing is the cash income. Is what? The cash flow from operating is much more than the net income, right? So these 3 you can quickly see in those like four metrics that I teach you. But in Cheetah score, there's a lot more than that. We look for like gross profit margin and growth of everything like book value, dividend increasing, everything. So for the 4 and 5, you should look for the debt ratio and everything. And for the number 5, you should look for the dividend payout, the share repurchase, and the CapEx and everything to see the management have the great decision to expand the business or not. And the Cheetah line I already told you is from the cash flow and the asset of the company. And here we can see the Roscoe, right? And here's the TSCO, the tractor supply. You can see that since 2008 to 2010, the price always below the fair price, right? And the revenue increasing, so you can invest in this year. But in 2012, 2013, 2014, as you can see, it's a little bit overvalued. So maybe you can wait, or you can use your money to invest in other investment opportunity, right? Everything that match your criteria. Because if you see here in 2013, if you bought or if you invested in this company, the price is like just flat to the end of 2014, right? It's unlike when in 2008, 2009, 2010, that is always increasing up and up. ULTA as well. If you invest in a great company at a very high price, overpriced here like 2012, your price is not going anywhere. Even though the company can increase in revenue and operating margin, the stock price will not go that far because it's already overpriced. And the price line is a good example. In 2014 and 2015, if you can remember, in the last year, the operating margin is not increasing a lot, right? They kind of oversaturated. And you can see that it's a lot overvalued since 2014. So the price keep moving up and down between like 1,000 to 1,400. So the stock price not going up every year like before, right? So if you look at Chitta, you can see the Chitta score here and everything here and make your decision like a lot quicker. And to see the proof of the Chitta concept, this one is really interesting. So when I created Chitta and I have the Chitta score and Chitta line, the quality and the fair price of every stock in the United States, right? I want to prove it because I'm an engineer. Whether Warren Buffett theory is actually working, right? I want to challenge him. So I plot all the stock based on their Chitta score here on the x-axis. From awful company to the wonderful company, Chitta score of 0 to Chitta score of 10. And the y-axis is the price relative to the fair price. So if the price score is 10, it means the price is a lot undervalued. And the price score of 0 is mean the price is a lot overvalued. And then wait and see like after 1 year, 5 years, what's the performance of the stock? And the green one is the profitable one. The red one is the losing one. So as you can see here, if you invest in the top right corner of the matrix or the wonderful company that's still undervalued, 80% chance that you have the profitable stock if you hold it more than 1 year, right? Interesting, right? So as Warren Buffett said, always stay in your circle of competency, right? So you should invest in the very easy thing, not the very difficult thing. Invest in a great company and undervalue. So here, 80% chance of winning. And if you move further down to the bottom left of the matrix, it's where there are a lot of ugly company or awful company and over fair price. 80% of the stock here happen to losing you a lot of money. So check again what quadrant that your stock are sitting in the matrix, right? And then after I created the Chitta matrix, I also created the Chitta ranking, which you can see on Chitta right now. It ranked the stock by the investment opportunity or the wonderful company that's still under the fair price or high Chitta score and the price still below the Chitta line. So you can check it out. And then the performance of the ranking that I have the backtest is like beat S&P 500 by a lot of number. Because as I speak in the first slide, right, first two slides, that if you have the right strategy or right methodology to select only the great company undervalue out of the market, you should always beat the market, right? So I have the test until like top 5, top 10, top 20, even top 100. If you buy only the great 100 stock out of the 500 stock of S&P, you still beat S&P by many percent. And then for you, I think you are a more serious investor, right? You should look at the numbers too. Not just look at the Chitta score and Chitta line. It's the great measurement for you to first look at every stock like very quickly. And after that, you have to look at the numbers, whether it works or not, right? So I have the Chitta fact sheet that shows you 10 years of financial numbers. Also 10 quarters back financial number that you can see every quarter. And you can add your own financial data to the Chitta fact sheet as well. And the last slide, she shows me I only have 1 minute. You want me to show you step by step to pick the stock? So you should give me like 5 more minutes. So after all I presented to you, this is the step that you can take to look at the stock at your home tonight. The first thing is to search for stock at cheetah.com. Second thing is to check out the score on the line. The hint is that the stock that you should invest should have cheetah score more than 5, which means the performance is above average, and the price below the cheetah line. So you know you have a good thing and still undervalued. And then you go to the fact sheet, which I show you a lot of financial numbers. I'm gonna show you in the next minute. You go to the fact sheet, and the first thing you have to look is the revenue growth. As I said, if there is no revenue growth, the company cannot sell anything, right? So if the revenue growth is good, is higher than 10%, you should look further. If the less than 10%, just pass it, right? If the growth is like more than 20%, you should spend all the night looking into it, right? It's a great company. It has something. And then you look at the net income and the cash flow from operating, right? If the net income keep increasing and you have more cash than the numbers, you should look further, right? Otherwise, go back to sleep, right? Then you look at all the margin, gross profit margin, operating margin, and net profit margin. If these three things increasing by 10% growth, you should invest in this stock. But if you want to look only one margin, what you should look for? The operating margin, right? But it's better to look all the three. If all the three is increasing, you got a good chance to profit from this stock. And after that, do the tedious work. Just go to annual report, and you can sleep all the night, sleep well all the night, right? Just read annual report before you go to sleep. So I wanna give you the quick minutes to show you the demo of the step by step. So the first thing you have to look is, okay, give me one stock, the good one. If you're not giving me the stock, so I just random it. Okay, yeah. So I random it. Okay, SYNT. So coming out. Okay. So you have the very high score, right? 8.03. And the price is around 2% below the fair price, right? The green number next to the cheetah score shows you the relative price to the fair price. So it passed your first criteria, right? Good company under the fair price. Then you go to the fact sheet. What you should look for next? What's that? Hey, wake up. What you should look for? The revenue growth, right? So in the fact sheet, here we have the annual rate here. So you see right now, the revenue growth, for those of you that sit behind, so far away, the revenue growth in the past 5 years of this stock is 12.5%. In the past 3 years is 9.9%. In the last year is 6.1%. So what do you think about this trend? Going down, right? No more growth of the company is less than 10%. So pass it on, because it's not gonna make you a lot of money. So okay, pass it on. So I random it again. So maybe we have to spend like 1 hour until we find a good company to invest, right? So US Bond Corp, so 7.65% and 1.6% below the cheetah line. And we check the fact sheet, and we see that, okay, revenue growth is 4%, 2%, and 3%. So what should we do? Pass it out. Okay. Again. Random it again. Hey, give me the good one. Give me the good one. So United Therapeutics Corporation, 7.15 and 58% below the fair price right now. Something might happen with the company, so the stock price tanked down. So let's look at the fact sheet. And you can see that, wow, we got something here. Revenue increasing like 25% in the past 5 years, 22% in the past 3 years, and 17% last year. So it's good to look deeper into it, right? So what's next we should look at into? What? Louder. Net income, okay. The net income is increasing from $74 million to $651 million. So it's impressive, right? And we check out the cash from operating with the net income. So it's highlighted, two line highlighted. If you can see it, what do you say? The cash is less than the net income, right? Like for the last year, you have net income of $651 million, but you have cash from the operating activity is only $282 million. So what should we do? Pass it, right? Easy, right? Easy process, right? But actually it's hard working. Thanks for technology that we have this. Otherwise, we have to spend times like Warren Buffett to read it every day and every night to cover all the financial data like this. So what time do we have it? Okay, so maybe I should think of one good company for you. Anyone have any idea? So maybe the last company. Let me check it out. JBHT. Okay, 7.75, 20% under the fair price. The growth is not that great. But imagine if it passed all the revenue growth, right? And it passed the income, right, growth, and the cash from the operating activity is more than the net income every year. Then you should look for the operating margin, right? Yeah. The gross profit margin, operating margin, and the net profit margin. So as you can see here, it's always increasing. And in the past year, it increased more than 10% for the operating margin, right? Then what should we do next? We should go to see the annually numbers, whether the operating margin is increasing year over year. As you can see here, if you check in the first quarter of 2015 compared to the first quarter of 2014, the operating margin increased from 8 to 10. From 2014, 10 to 11. For third quarter, 10 to 12, 11 to 11.9, and 10.8 to 11%. So if you see the growth of the operating margin every quarter, that's when you should go to the next step to read annual report to see whether this is a great company, what the product they sell, where the customer are, and everything. And if everything passes all of your criteria, you should invest in this stock. So I think we run out of time. Thank you very much. And if you have any questions, feel free to ask me at my booth out there at PW. Thank you.